with the Great Reset, it's really just the announcement of the plain facts of where the whole world is financially speaking, that we are all on the precipice of an economic ending of fiat currency that has no hard asset backing. We are at the end of that. We were again at the end in 2019. Coronavirus came on and we were able to sustain with a lot more stimulus these last 2 years. But now inflation has come. We're finally feeling the economic indicators of what these central banks have actually done to us. They're raising interest rates to get this under control. And that brings me to our Federal Reserve dilemma. And this is why we're at the end of this fiat currency. I had a client ask me, Rebecca, what does fiat mean? Fiat means it's fake, means it's not based on anything other than the sovereignty of the nation who's creating the debt. So the United States Treasury bill that is issued by the Federal Reserve is backed up by the full faith and credit of the United States government. That means that there's no hard asset back here like gold saying, okay, we'll let you convert your dollars for gold because it's a hard asset backed currency. It is not hard asset backed at all. And in fact, it is exactly as I'm explaining it. So now that we have reached to this reconciliation point, the Fed is between a rock and a hard place, no pun intended. And the reason for that is they've done the analysis and they know that in order to get interest rates really in control of inflation, they'd have to get the Fed funds rate to about 4%. So we're at a 1.75 right now. After all the rate hikes we've already had this year, we're still only at 1.75. If that gives you any kind of understanding of the scope of the continued raising of rates we'd have to see in order to get Fed funds at 4%. So they know the analysis is they need to keep pushing. They need to keep pushing. If you look at this week in the market, you see that the second that we got minutes from the last meeting last month in August, and we were able to digest those minutes, and those minutes looked and appeared to be a lot more dovish. The market loved that. The market loved the fact that it thought that the Fed was indicating that if they get a continuous amount of indicators economically, jobs numbers, inflation numbers, if they can continue to get CPI numbers and economic job numbers that will agree, they might not have to continue their aggressive raising of rates. This was in their minutes from August. So the market loved that and thought, wait, could this be the first indication that the Fed might actually change course? And the market loves that. The problem is if the Fed changes course and goes back to accommodative and stimulus, then the market's going to love that for about a half of a trading day or maybe 2 trading days at the most. And then the market's going to realize, okay, the Fed isn't serious about keeping the dollar strong.